First, I'll talk a little bit about some of the factors in the market that have really been driving the dislocation in some of these lower quality sectors, and then how that plays into where the potential opportunity is in investing right now. The dislocation as it relates to more marginal credit participants in the market really has its roots in changes in the structure of the market over the last 10 plus years since the global financial crisis. In particular, very significant growth in corporate credit markets, large growth in both below investment grade and within the investment grade universe. In the non-investment grade space, it's really two areas to focus on. One has been the significant growth in the leveraged loan universe as CLOs have become a much larger player in leveraged loans. CLOs today represent slightly more than half, or at least pre-pandemic represented slightly more than half of the incremental demand for most leveraged loan new issue over the past few years. Also, the private credit markets have grown tremendously from a size of under $100 billion, roughly $80 billion at the time of the GFC, to now today about $1 trillion in total size. So very significant growth in that area. The private capital markets generally always lag the public capital markets in terms of their ability to create new capital for companies. With patience, we think you can deploy capital over time as companies face significant stresses for those who have, again, not been able to access sources of liquidity, and companies utilize the flexibility that they have within the four walls of their business to try to survive this pandemic period. We think ultimately there will be even higher return opportunities coming later. Some of them might involve restructurings of businesses or repairs of balance sheets through those new money transactions, but we think that pivot to some of those deals will come as the year moves on and as we move into 2021. We see some of the best relative value today across the landscape in structured products, whether it's in CMBS or high-quality asset-backed securities, some corners of the RMBS space that are more credit-intensive. That's where we see some of the best near-term opportunity from a dislocation perspective. We also see some of the recent secured new issue by companies that are under stress, needing to raise liquidity and pledging fresh assets that had never been pledged before to issue credit. We've seen pretty good value in those corners as well. From a distress perspective, particularly on the more private or less liquid situations, in the near term, the opportunity becomes companies that are under real stress where you can access paper in the public markets at deeply distressed levels. We see our pipeline of the private capital solutions activity really starting to pick up steam. Again, given the repricing that needs to happen in that space, it'll be a while before some of those transactions actually close at levels that we find attractive, but we can tell you that definitively the amount of deal flow that we're seeing there is increasing quite strongly.